And I'd like to turn now to our final presenter, Patricia Wang. Patricia is a fellow of both the Actuarial Society of South Africa and the Institute and Faculty of Actuaries, having a combined 10 years of experience in the South African and London markets. Her experience is primarily in financial reporting, financial modelling, machine learning and data analytics. She completed her undergraduate studies in actuarial science at UCT and a MSc with distinction at Imperial College London in data analytics and machine learning. Patricia is specifically interested in using machine learning and data analytic tools to resolve business problems in the life and health insurance sector in 2019. Patricia served as a committee member of the IFOA Asia Conference, is fluent in English and Chinese, and is a speaker at various actuarial and financial conferences and events. Please join me in welcoming Patricia.
Thanks, Scott, for the introduction. Oops. And thank you for joining me on using machine learning models and explanatory AI to predict and explain underwriting decisions for life and health insurance. When I started this project, I consulted a couple of underwriters. One of them asked me, "Are you creating a Terminator for underwriters?" And the short answer is no, and hopefully it will become clearer throughout the presentation. He then asked me, then why do we need machine learning models and how are they different from the current automation tools? Well, that's a very good question. So let's have a look at the current underwriting approach. So applications are first processed by a so-called rule-based engine. It is currently the dominant automation tool in the market. It is essentially a box of a finite number of underwriting rules encoded into the box. So this means that only a proportion of applications can be processed by these rule-based engines. This proportion is often quoted as the straight-through rate that you might have come across in a marketing material. Those cases that cannot be processed by these rule-based engines are then passed on to human underwriters of insurance company. And if for some reason the underwriters of insurance companies still can't make decision on these cases, they are passed on to reinsurers whose underwriters can weigh in on their opinions. So the red box here represents part of the process that is costly, time-consuming, and often resulting loss of sales. So this is the part of the process we want to improve. So back to the question, why do we need machine learning models? First, I trained machine learning models using the referral cases for the insurers. So by definition, they're able to process the cases that the current automation tools cannot process. And second, machine learning models are predictive, meaning they learn the pattern and the underwriting rules from the data, as opposed to the current automation tool, which are deterministic, meaning they require someone to encode a finite number of rules into the box. So by definition, the current automation tools will always have less than 100% straight-through rate. So immediately, even if you don't want to completely abandon your current automation process, you can incorporate a machine learning model into your process to at least improve your straight-through rate. Lastly, as perhaps a more subtle rate, is that machine learning in this context is slightly different from your standard supervised learning in the sense that in a standard setting, your observed values are some true factual values such as petal length and colors, where the image is cat or dog. Whereas here, the underwriting decisions are human decisions, which may be subjective, inconsistent, and possibly erroneous. Although I expect them to be small, given that underwriters are the experts in this field. That being said, it does mean that when the model predicts a case to be a different decision to the observed underwriting decision, rather than just assume that the model made a failed prediction, it is always worthwhile to investigate why. And sometimes these investigations can highlight some of the issues in your current automation or underwriting process. So let's have a look at how the underwriting decisions are coded. Underwriting is often described as a risk classification process. So the loadings are the multiples to be applied on top of some baseline premium rates that pricing actuaries come up with. But the loadings themselves are not some formula-driven calculated numbers, but rather a risk indicator. This is why that in practice, underwriters will only give loadings in multiples of 25% because 25% is the appropriate increment level to indicate or distinguish between the level of riskiness. As a result, the models are designed to follow this practice. So basically, you take the underwriting loadings, divide by 25% to create the labels. I grouped all the cases with underwriting loadings greater than 400% into one class because in practice, these cases are extremely rare. So I grouped them together in one class to give this class sufficient data points. As a result, there are 19 classes in total. So this is a multi-class classification as opposed to binary classification that you might have come across in a lot of machine learning discussions. This table here shows the model performances of 10 different algorithms/models that I trained. I divided data set into the training data set and testing data set in the ratio of 80% to 20% randomly. And the models are trained on the training data set without being exposed to the testing data set. And the performances on the testing data set, therefore, are more important because it shows how well your model generalized to unseen data. Whether you should use the different performance matrix, whether you should use recall score or precision score depend on whether you care more about false negatives or false positives. And this is partially related to your underwriting philosophy. And F1 score is just the harmonic mean between the two scores that I just mentioned. So there are 33 insurers in the data set, and without knowing all the underwriting philosophies of all those insurers in the data, I'm just using the accuracy score as the main performance metric because it's easy to understand and it's just the number of correct predictions divided by the number of data points in your data set. But as you can see, the extreme gradient boost model achieved the best performance results across all the performance metrics on both the training data set and the testing data set. In particular, it achieved 99.5% prediction accuracy on the training data set and 81.1% prediction accuracy on the testing data set. So for the rest of the presentation, I will just concentrate on this model only because of the time constraint. This table here shows how the extreme gradient boost model performed across different classes. You can see that it achieved 93.8% prediction accuracy on the testing data set. So this means that of all the cases that your human underwriters decided to be a standard case, the model correctly predicted 93.8% of them. So for other classes, the performances are not as great as the standard class. But bear in mind, as a rule of thumb, for machine learning, you need at least 10 data points per feature. There are 118 features in the data set, and even after feature selection, there are 77 features remaining in the data set. So that means that for all the classes with data points fewer than 1,200 approximately, the model did not have sufficient data points to learn the actual true patterns and underwriting rules for that class. This does suggest that if we keep collecting good quality of data, we can improve the model performance. Having said that, it is still worthwhile to deploy the extreme gradient boost model as it is now, given that the prediction accuracy on the testing data set is really, really good. This shows that the model generalized really well to unseen data for standard class. So as I mentioned before, even if you don't want to abandon your current automation tool, you can incorporate this model into your process and improve your straight-through rate. Let's have a look at the histogram of differences between the predicted and observed underwriting decisions. So as expected, 81.1% of them are correct predictions, so no difference between the two. That's this tall blue bar here. If we just concentrate on the failed predictions, so 328 cases out of 416 failed predictions are just small differences between the predicted and observed underwriting loadings, meaning they aren't likely to have significant financial impact, especially when the observed underwriting loadings are human decisions, which may be subjective. There are 26 cases that are 26 decline cases that are predicted to be standard, and 29 cases, standard case predicted to be decline. So if we add those two categories together, that's 55 cases, which translates to 2.5% of the testing data set. Even though this is a small percentage of the testing data set, it is still worthwhile to investigate why they fall into the wrong category, given that potentially they may have bigger financial impact. Which is why I used explanatory AI method to investigate these 55 cases. So LIME stands for Local Interpretable Model Agnostic Explanations. It's model agnostic because you can use this method to explain any underlying machine learning models. It doesn't depend on the underlying machine learning model. It's local because it's essentially building a regression model using the data points in the neighborhood of data point of interest to approximate the underlying machine learning predictions. So here, the model predicts the case to be a standard case, whereas the observed underwriting decision is decline. And let's have a look at this case. This case has no pre-existing condition, no family history of any pre-existing condition, and healthy BMI of 22. So based on this, the model prediction actually makes more sense. So why is observed underwriting decision decline then? After discussing with underwriters, I realized that in practice, a lot of underwriters don't actually record or update the medical information in the data, especially when they decided the case is a decline case, since the insurer is not on risk to these cases. While it may make sense and obviously convenient from an underwriting point of view, it does impose modeling difficulty because these cases with large or pre-existing conditions appear to be the same as healthy applicants with no pre-existing conditions. And this is why this is the result. So this suggests that if we impose some data capturing standard, which should be relatively easy to do in practice, we can help the model to achieve better performance. SHAP method is also a very popular explanatory AI method that is gaining momentum in the last couple of years since its publication. It stands for Shapely Additive Explanations, and it's based on the game theory. So here, the model output is the game, and features or columns or input variables are the players. So this method starts with zero feature model, which is just observed mean, and compare one feature model outputs against this observed mean to calculate the marginal contribution of all the features. It then moves on to two feature model outputs and compare it against one feature model outputs to calculate the marginal contributions again, and so on, until it has considered all the possible combinations of all the features for a given feature set. Now we know that the order of adding features into the model will impact on the marginal contribution attributed to each feature. This is why you want to minimize the impact of different orders. Now, a shape value of a feature is the weighted average of all the marginal contributions for that feature from all the collisions containing that feature. This way, the impact of different orders is minimized. This method is also model agnostic, as mentioned before. So based on all the above factors, this is why it is often considered that feature ranking using shape value is more stable than model-dependent feature ranking. So let's have a look at feature ranking using mean absolute SHAP value. So you can see that different colors represents different classes. And we can see that BMI is the biggest contributor across different classes, so on a global scale, followed by face amount and weight. Weight obviously is closely related to BMI, but adds slightly more information because some individuals may have healthy BMI values, but if their weights are above a certain threshold, there is still a health risk. And a classic example would be rugby players. You can also see that amongst all the medical conditions, heart, diabetes, and psychological conditions are the top 3 conditions. And cancer, on the other hand, is not even ranked in the top 5 amongst all the medical conditions. And this is not because there are fewer cancer cases in the data. Actually, on the contrary, there are more cancer cases than diabetes cases in the data set. This would suggest that long-term, manageable chronic conditions have bigger impact on the underwriting decision than headline conditions such as cancer. And this is especially surprising when the data set contains not only income protection and disability products, but also mortality and critical illness products, with mortality product being the dominant product type in the data set. You can also see here that no condition indicator is the biggest, is ranked as 6 across different classes. But by far, it is the biggest contributor to standard class, as seen as tall blue bar here. And similarly, for indicator company X, it is ranked 7th across all the classes, but it's by far the biggest contributor to class with loadings greater than 400%. Perhaps this last point is better illustrated by this animated bar chart. It should play itself, but it's looking like it's not doing that. So I'm just going to manually scroll the bar. So what this does is basically showing we fix the feature orders on the x-axis, and each bar represents the marginal contribution of a feature. And if we move across different classes, we can see the movements of the bars. And this basically shows that features contribute differently to different classes. For example, here we are looking at decline class, and the biggest contributor is, the biggest contributor is face amount. And if we move back to the class with loadings greater than 400%, we can see the biggest contributor is company X. And this indicator is not one of the big contributors for decline class. So this suggests that company X tend to accept high-risk cases with extremely large loadings rather than declining them. And if we move back to a standard class, we can see that no condition indicator is the biggest contributor, and BMI is the second biggest contributor when BMI is the biggest contributor globally. This makes sense because healthy applicants tend to get standard rating, and if we already know that someone doesn't have a pre-existing condition, their BMI values are not as important as compared to other classes where we tend to use BMI values as a proxy for the overall health condition. We just had a look at a SHAP plot on a global scale. We can also look at SHAP plot for Cohort. So here you're looking at decision plot for standard class on the testing data set. On your left, you're looking at ranking of all the features, and on the right, you're looking at the top 20 features. So the right graph is just a blown up version of the top part of the right graph. This kind of plot is quite useful when you want to identify the classic or typical path, decision path. So for example, here, the decision typically take a big sharp to the left or right, depending on whether no condition indicator is switched on and off. And all the features are ranked in descending order of marginal contributions. And this is why you see this like funnel shape. So this kind of graph is also quite useful when you want to identify outliers. So each line is a different data point, and outliers, these lines here are basically the outliers because they deviate from the central cluster. You can also identify the features that have big impacts on the outliers but may not rank high. For example, family history is here. Family history is the indicator where the outliers tend to take a big step to the left when this condition is switched off. We can also use SHAP value to explain the model prediction for a single instance. So here, the model correctly predicts a case to be a standard case. You might have noticed that the feature ranking is slightly different from the feature ranking for standard class as a cohort. And this is because the features are ranked for this specific instance only. And this waterfall plot also shows whether each feature has a negative or positive impact on the model output, as well as the magnitude of the impact. And also it shows the feature value. So this applicant the no condition is switched off, meaning this applicant has a condition, but probably minor given that this applicant has a healthy BMI value of 21 at age of 57. So this confirms that the model is behaving as what we expect. This kind of graph is quite useful when the underwriters or brokers need to explain the model predictions to the customer, especially we are on an increasing level to demonstrate transparency. You can also use this graph to explain a model prediction to senior stakeholders and demonstrate that machine learning models are not black box models and can be trusted. There are a couple of other interesting SHAP plots, but I will skip them to a conclusion because I'm running out of time. So we just had a look at machine learning models and explanatory AI can be used to predict and explain the underwriting decisions for life and health insurance. And particularly the extreme gradient boost model achieved 99.5% prediction accuracy on the training data set and 81.1% prediction accuracy on the testing data set. More specifically, achieved 93.8% prediction accuracy on the testing data set for standard class. So this generalized extremely well for unseen data for standard class. So you can incorporate this model into your current underwriting process to improve your straight-through rate. We also had a look at the histogram of differences between the predicted and observed underwriting loadings and saw that roughly 80% of the failed predictions are just small differences between the predicted and observed underwriting loadings, so they aren't likely to have a significant financial impact. We investigated the 55 cases, which is roughly 2.5% of the testing data set, using an explanatory AI method called Outlier, and realized that this is because in practice a lot of underwriters don't record or update medical information in the data, and imposing data capturing standard will help us to improve the model performance. We also used a SHAP method to look at model predictions on the global, cohort, and an individual level, and gain some interesting underwriting insights. And obviously, you can use this plot to explain your model predictions to various stakeholders, such as customers and senior board members, to demonstrate that machine learning models are not black box models and can be trusted. Lastly, I hope that my presentation has demonstrated that you can use machine learning models and explanatory AI to help your underwriters and improve your current underwriting process. They're kind of like the T800 in the Judgment Day 2. They may look like a Terminator, but they're here to help. Thank you.